Whatever the mode of international business, it involves cross-border movement of funds. The movement of funds is reflected in a country's balance of payment. In other words, balance of payment shows the financial impact of international business. It is from the point of view that it is essential to acquaint the readers with the basic concept of balance of payments and its structure. The present chapter also includes equilibrium, disequilibrium and adjustment mechanism phenomenon related to balance of payment, that is BOP. After studying this module, you shall be able to understand the concept of balance of payment and its structure, explain the balance of payment equilibrium and disequilibrium, analyze the role of different theories of balance of payment to adjust its disequilibrium. Let us now first understand the concept and structure of balance of payment. Concept of balance of payment. The concept of balance of payment is used in various ways and can have different connotations. Here we use the concept that had given by MATLAB to define the balance of payment in different ways. MATLAB had pointed out that the fundamentally different ideas are continually used by the same name, the balance of payments. Accordingly, balance of payment may be first an accounting balance, that is balance of credits and debits, or second a program balance, that is balance of hopes and desires, or third a market balance, that is a balance of supply and demand. Accounting balance. The accounting balance of payment of a country is a systematic record of all economic transactions between the residents of a country and the rest of the world during specific period. It is an ex post concept used on statistical information and estimates. It shows the character and dimensions of the country's international economic relationship, the country's trading position, changes in its net position as foreign lenders and borrowers, changes in its official reserve holdings. Accounting balance, by virtue of its basic feature, has insufficient information for formulating and conducting the payments policy. The accounting balance is essentially classificatory and not analytical. Program balance. The program balance of payments is a statement of sources and uses of foreign funds expected or planned over a future period of 1 or more years. It is based upon the nation's investment and consumption requirements and on a program of meeting an excess of requirement over the resources by the foreign funds expected or sought. It is a forecast of the country's exchange needs and desires. Deficits and surpluses are defined in terms of gaps between the needs and desires on the one hand and the amount of foreign exchange expected to become available from all regular sources on the other hand. Market balance. The market balance of payment is characterized by the effective demand and supply of the foreign exchange at the given exchange rates. This is an ex ante concept with major emphasis on the effects which the changes in the exchange rates might have upon the amounts of exchange effectively demanded and supplied. Thus, it compares the autonomous spending and receipts given present and expected future incomes, prices and interest rates. Accordingly, the rate of exchange is the product of interaction of demand and supply schedules. Structure of BOP. The transactions entering the balance of payment can be broadly divided into three categories. First, transactions in goods and services. Second, transfer payments. And third, the capital transactions. Both the transactions in goods and services and capital involve a quid pro quo. Transfer payments, on the other side, are the payments from some person or body of another country without a quid pro quo. Thus, they are usually called unrequited transfers or unilateral transfers. Balance of payments measures flows rather than stocks during a specific period. Balance of payment data records only the changes in assets, holdings and liabilities. These do not represent the absolute level of the items included in the balance sheet. Therefore, balance of payments of a country is the statement of sources and uses of funds. For a country, the sources of funds are acquisitions of external purchasing power, that is, a right a country has to claim goods and services or to invest in another country. The balance of payment transactions, therefore, is showing acquisition of funds and uses of funds among countries. These transactions are divided vertically into credits and debits accounting to the principle of double entry bookkeeping. Accordingly, the debits always equals the credits and the balance of payment accounts are always in balance. If debit side is more than the credit side, then the resulted gap is known as the balance of payment deficit, and vice versa. Transactions are also divided horizontally into major categories, that is current accounts and capital accounts. The structure of BOP is categorized into three parts: current account, capital account and foreign exchange reserve account. So, till now we have studied the concept and structure of BOP. Let us now understand what is BOP equilibrium and disequilibrium. BOP equilibrium. Since the balance of payment is constructed on the basis of double entry bookkeeping, credit is always equals to debit. If debit on the current account is greater than the credit side, funds flow into the country which are recorded on the credit side of the capital account. The excess of debit is wiped out. Thus, the concept of balance of payment is based on the concept of accounting equilibrium, that is, current account plus capital account is equals to 0. The accounting balance is an ex post concept. It describes what has actually happened over a specific past period. There may be accounting disequilibrium when the two sides of the autonomous flows differ in size. But in such cases, accommodating flows bring the balance of payment back to equilibrium. Balance of payment disequilibrium. In economic terms, balance of payments equilibrium occurs when surplus or deficits is eliminated from the balance of payments. However, normally in real life, such equilibrium is not found. Rather, it is the disequilibrium in the balance of payment that is a normal phenomenon. In case of developing countries like India, China, etc., the tendency of disequilibrium always exists. Types of disequilibrium. In the absence of long-term capital or with insufficient movements, disequilibrium can be classified broadly into those stemming from income, those from structural causes involving relative prices, and those which are a mixture of income and price. Income disequilibrium is those in which income changes in relation to the national income abroad without significant changes in the relative prices. Structural changes are those which occurs primarily in relative prices without necessarily significant changes in the level of the national income. The intermediate category involves the case of over and undervaluation of the exchange rate produced by the changes in the exchange rate or by the domestic inflation. These are the cases of income and price. Cyclical disequilibrium. Cyclical disequilibrium occurs either because the pattern or the business cycle in different countries follow different paths, or because income elasticity of demand for imports in different countries are different. In figure, national money income is stable in B and fluctuates cyclically in A. Income elasticities of demand for imports may or may not be the same. The income elasticity of demand for imports in B is not involved since income is stable. In this situation, A's import will decline in depression and rise in prosperity. B's imports will continue steady. The result is that A will have an export surplus in depression and an import surplus in prosperity, and B will have a deficit when A is depressed and a surplus when A is prosperous. If the national income of A and B both follow the cyclical path of A and income elasticities of import in both countries are unity and hence identical, there will be no disequilibrium. Secular disequilibrium. Under secular stagnation, investment opportunities are inadequate to absorb the full employment savings. In periods of secular exhilaration, on the contrary, investment is too high relative to the savings of the economy. The cause of the imbalance in the Keynesian system, of course, is that the forces lying behind savings and investments are different, and both are relatively inelastic with respect to the rate of interest. Savings are a function of incomes to some degree of wealth and of the institutional forces such as the practices in life insurance and mortgage amortization. Investment, on the other hand, is responsive to innovation, population change, availability of management, and so on. In particular, countries may tend to have many investment opportunities relative to savings in the early stages of growth and the opposite at a later stages. Structural disequilibrium. Structural disequilibrium may be caused by a non-systematic change in taste or in technology or in anything which alters the prices of an export upward or downward. An increase in the foreign demand for a country's output is structural disequilibrium of a sort, but one with which it is not difficult to deal. The remedy is an increase in output of the product and increase in the consumption and imports by the country. The cause of the disturbance may be a change in supply. The classical illustration is crop failure, which cut off the supply of a country's exports and produced a shortfall of exports below imports. A bumper crop abroad which lowered the world prices would have much the same effect. Others are exhaustion of the soil of mines. Random disequilibrium. Random disequilibrium is not a permanent cause or the specific cause of disequilibrium. This kind of disequilibrium exists because of the adjustment process. Now, we will move on to analyze the role of different approaches of BOP to adjust its disequilibrium. First is the elasticity approach. The traditional approach in respect of the effects of devaluation is condensed in the form of Marshall-Lerner condition. It means exports earnings will increase and imports expenditure will decline if the price elasticity is more than the proportionate, that is, if it exceeds the unity or greater than unity. This situation is known as Marshall and Lerner condition since it was discovered in 1923 by A. Marshall and later in 1944 by Abba P. Lerner. The essence of this condition is that an improvement in competitiveness, that is in the relative prices, will improve the trade balance and balance of payment only if the sum of price elasticity of demand and supply for imports by the residents and the price elasticity of demand for the exports by the non-residents is more than proportionate, that is, if it exceeds or is greater than unity. The important point to note here is that the emphasis of Marshall-Lerner condition is on the sum of the elasticity and not on the elasticity separately. For this reason, the theory is called elasticity theory. This may also be called the theory of price effects on the balance of payment. In case of deficit, current account balance, they recommended for devaluation of currency. If the currency is devalued, export becomes cheaper and imports become expensive. Thus, exports increases and imports decreases, which automatically leads balance of payment back in the equilibrium. But there is a condition that price elasticity must be greater than unity. That is, the price elasticity greater than 1 and the elasticity of import plus the elasticity of export must also be greater than 1. The purpose of the elasticity theory is to bring out the effects of the price changes on the balance of payments. The theory provides the basis for a policy measure like devaluation of a currency as it indicates the condition required for the success of devaluation as a measure to correct adverse balance of payment position. J-curve effect. If the elasticity of demand is greater than unity, the import bill will contract and export earning will increase as a sequel to devaluation. Trade deficit will be removed. However, the problem is that the trade partner may also devalue its own currency as a retaliatory measure. Moreover, there may be a long lapse of time before the quantities adjust sufficiently to a change in price. Till then, the trade balance will be even worse than that before devaluation. This is nothing but the J-curve effect of devaluation. Trade balance moves deeper into the deficit zone immediately after devaluation, but then it gradually improves and crosses into surplus zone. The curve resembles the alphabet J, and so it is known as the J-curve effect. On the basis of experiences of India, trade deficit was very high in 1965, and then India devalued rupees by 36% in June 1965. Exports should have gone up, but exports increased only in 1972. Between 1966 and 1971, devaluation does not help export to rise. So, this theory was examined by many experts and they realized that there is a lag between the devaluation and rising exports. Apart from this, the theory also suffers with some other limitations. First, it assumes that the country's balance of payment position is in balance initially and that changes in price would affect the balance of payment. That is not correct, as no country's balance of payment is in balance, that is neither surplus nor deficit. Second, generally exports and imports consist of thousands of different items and it is difficult to estimate elasticities for all these individually or in aggregate. Third, Marshall-Lerner condition assumes that the supply side is highly flexible, that is, there are no difficulties in the availability of goods for export and production will quickly respond to the changes in the foreign demand. That is not correct. The most important of these other influences is the change in the income. Fourth, lastly, the elasticities theory overemphasizes the role of trade in improving a country's balance of payments. Changes will take place in other parts of the balance of payments as well as that is in the current account as a whole as well as in the capital account. Second is the absorption approach. This approach is developed in 1952 by S.S. Alexander of the International Monetary Fund, that is based on Keynes' theory of balance of payments, which explains the balance of payment on current account as a macroeconomic phenomenon. It focuses attentions on the relationship between international trade and the domestic economy on the domestic economic activity represented by national income or gross national product, that is GNP. National income or national output is the sum of total of economy activity of a country during a year, that is a sum total of goods and services produced in a year in an economy. This may be measured as income earned by its population or as output produced by the economy or as expenditure or the total spending in the economy. For the purpose of absorption, what is relevant is the latter two, that is output and spending or expenditure. Total availability or aggregate supply of goods and services in the economy is represented by output. What is produced is also used for consumption and investment in the economy. This is the total spending. Now, the relationship between income or output and expenditure or spending may be expressed. Thus, Y is equals to C plus I, where Y stands for the income or the output, C stands for the consumption and I stands for the investment spending. In a closed economy, that is an economy which has no transaction with the rest of the world, all national income or output will flow between the producers and the consumers within the economy. As a result, there will be no tendency for national income or the output to change unless consumers on their own change their production level. Thus, Keynes' theory of income predicts that when there is a change in the level of either consumption or saving or investment, national income or output will increase or decrease. In an open economy, however, foreign trade influences national income or national output through the changes in exports and imports. An increase in export earning is in addition to the national income stream, and spending on imports is a subtraction from the income stream. The increase in exports increases the national income, and increase in imports causes a decline in it. This relationship between the national income or the output and foreign trade may be expressed thus: y is equals to C plus I plus x minus m, where y stands for the national income or the output, C stands for the consumption, I stands for the investment spending, M stands for the imports, and X stands for the exports. The question is now, by how much will the national income increase due to an increase in exports? This is measured by the ratio of increase in national income to the increase in export earning. This ratio is called foreign trade multiplier. Similarly, national income will decline due to the spending on imports is measured by the ratio of increase in imports to increase in income. This is called marginal propensity to imports. The net effect of the operation of these two tendencies determines the impact of foreign trade on national income. Third is the monetary approach. The monetary approach to the balance of payments or external transactions emphasizes the role played by the money supply in a country's balance of payment. This is because money supply is the basis for total or the aggregate demand in the economy. Every transaction in the economy is financed by the use of money. According to this approach, balance of payment surplus or deficit is a monetary phenomenon because it results from the excess demand for money or excess supply of money in the economy. If there is an excess money supply, it may be spent within the country and abroad, and the country will run into balance of payment deficit, leading to an outflow of the national currency. If there is an inflow of currency into the country, it means that the country is receiving more money than it is paying abroad. That is, there is a balance of payment surplus. In short, inflows and outflows of currency in an economy are associated with the balance of payment surplus and deficit. The important feature of this theory are that it establishes a relationship between the money supply and the balance of payment. The policy implications of this theory are twofold. First is that for a proper understanding of the balance of payment situation of a country, it is necessary to analyze the demand and supply of money in an economy. The second implication is that any balance of payment policy must aim to bring into balance the demand for money and supply of money by focusing attention on the control of domestic money supply. Mundell in 1968 has also incorporated the interest rate and the capital account in the ambit of discussion. In his view, it is not only government spending but also the interest rate that influences the income as well as the balance of payments. While larger government spending increases the income, an increase in income leads to a rise in imports. With a positive marginal propensity to import, any rise in income as a sequel to increase in government spending will lead to greater imports and worsen the current account. However, changes in interest rate, influence both the capital account and the current account. A higher interest rate will lead to improvement in current account through lowering of income. At the same time, a higher interest rate will improve the capital account by attracting foreign investment flow. New Cambridge School approach is the third approach, which takes into account the savings represented by S, investment represented by I, taxes represented by T, and government spending represented by G, and their impact on the trade account. In the form of equation, we can write the same as S plus T plus M is equals to G plus X plus I, or S minus I plus T minus G plus M minus X must be equals to 0, or X minus M is equals to S minus I plus T minus G. The theory assumes that S minus I, that is savings minus investment, and T minus G, that is taxes minus government spendings, are determined independently of each other and of the trade gap. S minus I is normally fixed as the private sector has a fixed net level of savings. So, the balance of payment deficit or surplus is dependent upon T minus G, that is taxes minus government spending, and constant S minus I, which is savings minus investment. In other words, with constant S minus I, it is only the manipulation of T minus G that is necessary and a sufficient tool for balance of payments adjustment. Let us now summarize what we have studied in this module. International business involves cross-border movement of funds. The movement of funds is reflected in a country's balance of payment. Next, balance of payment shows the financial impact of international business. Next, MacClub in 1950 had pointed out that fundamentally different ideas are continually used by the same name, that is by the balance of payment. Next, the accounting balance of payments of a country is a systematic record of all economic transactions between the residents of a country and the rest of the world during a specific period of time. It shows the character and dimensions of the country's international economic relationship, the country's trading position, changes in its net positions as the foreign lenders and borrowers, changes in its official reserve holdings. Next, accounting balance by the virtue of its basic feature has insufficient information for formulating and conducting the payments policy. The accounting balance is essentially classificatory and not analytical. It represents an ex post grouping of international transaction by the type or by transact, or it only indicates the extent of balance or imbalance of the past transactions. Next, the program balance of payment is a statement of sources and uses of foreign funds expected or planned over a future period of 1 or more years. It is based upon the nation's investment and consumption requirements and on a program by meeting an excess of requirement over resources by the foreign funds expected or sought. Next, the market balance of payment is characterized by the effective demand and supply of foreign exchange at the given exchange rates. This is an ex ante concept with major emphasis on the effects which the changes in the exchange rates might have upon the amounts of exchange effectively demanded and supplied. Next, the structure of BOP transactions can be broadly divided into three categories: transactions in goods and services, transfer payments, and capital transactions. Next, BOP equilibrium exists because it is based upon on the double entry accounting system. Credit is always equals to debit. Next, BOP disequilibrium is an economic concept which ex ante. According to this, there is always either surplus or deficit in a country's BOP situation. Next, there are four types of disequilibrium. It consisted of cyclical, structural, secular, and random disequilibrium. Next, there are three approaches to adjust the BOP disequilibrium. Next, elasticity approach considers the role of price effect on the balance of payment. Next, absorption approach considers the role of income effect on the balance of payment. Next, monetary approach considers the role of money supply on the balance of payment.